Silver just crossed $66.50, and if you understand what that number actually represents, you'd know this wasn't supposed to happen. Not yet. Not this cleanly. For months, institutional traders have been watching a very specific threshold, one that's rarely discussed outside of trading desks and risk management meetings. It's not a psychological level. It's not a technical pattern. It's a structural pressure point built into the futures market itself. And when it breaks, it doesn't just move price. It forces positions to unwind, margin calls to trigger, and exposure to surface that was never meant to be visible. The question is not whether silver can hold above 66. The question is, what happens now that the system designed to contain it just proved it can't? If you care about understanding what is really happening beneath these market moves, the kind of intelligence that doesn't make it into headlines until it's already over, make sure you're subscribed, because what you're about to hear isn't speculation, it's structural. This video is for educational purposes only and does not constitute financial advice. All commentary reflects publicly available data, market structure analysis, and broader macroeconomic context. Let's start with what actually happened. On the COMEX, the exchange where silver futures are traded and settled, there's a mechanism built into every contract. It's called a limit move. When price rises or falls beyond a certain threshold in a single session, trading can be paused or restricted. The system calls it a circuit breaker. Traders call it something else, a kill switch. It exists to prevent disorderly markets, to give institutions time to adjust, to keep volatility from spiraling out of control. But here's what most people miss. That limit isn't arbitrary. It's calculated based on recent volatility, open interest, and the amount of physical metal that can actually be delivered if contracts are called. And when silver pushed through 66.50, it didn't just break a price level. It broke through the tolerance band that the exchange uses to manage systemic risk. Now, why does that matter? Because the futures market isn't just about speculation, it's about control. The vast majority of silver contracts never result in physical delivery. They're rolled, closed, or cash settled. That's by design. It keeps the market liquid. It keeps prices stable. But it also means the system relies on one very fragile assumption, that most participants will never ask for the metal. The moment that assumption cracks, the entire structure has to recalibrate. And that recalibration doesn't happen smoothly. It happens in bursts. It happens when someone with enough size decides they'd rather hold the asset than the contract. And lately, that's exactly what's been happening. Over the past 8 weeks, COMEX silver inventories have declined by more than 18 million ounces. That's not a minor drawdown. That's a structural shift. Registered inventory, the portion available for delivery against futures contracts, is now sitting near multi-year lows. At the same time, open interest in silver futures has remained elevated. That creates a mismatch. Too many claims on too little metal. And when price starts to move, that mismatch turns into a liquidity problem. It's not that the market is running out of silver. It's that the market is running out of silver in the right place, in the right form, at the right time. This is where the vault leak comes in. It's not a literal leak. It's a term used by traders to describe what happens when physical metal starts moving out of exchange-approved warehouses faster than it is coming in. And it's not random, it's directional. Silver's leaving the system and going into private hands, into allocated storage, into jurisdictions where it won't be easily mobilized back into the futures market. Some of it is going to India, some to the Middle East. Some is being absorbed by funds that have shifted from paper exposure to physical backing. The effect is the same. The float is shrinking. Here's what makes this different from past rallies. In 2011, silver spiked on momentum and retail fever. It hit $49, then collapsed. Why? Because the move was driven by leveraged speculation, not by structural demand. The system had plenty of metal to deliver if it needed to. The futures market could absorb the pressure. But this time, the setup is inverted. The rally isn't being led by retail. It's being led by steady, persistent accumulation from entities that don't trade in and out. Central banks in emerging markets, sovereign wealth funds, industrial users locking in supply ahead of what they see as a tightening cycle. These aren't weak hands. They're not selling at the first sign of volatility. And that changes everything. Now let's talk about what the banks are doing, because they're not sitting still. The large commercial traders, the ones who typically hold the short side of the silver market, have been reducing their net short positions for weeks. That's unusual. Normally, when price rises, they add to shorts. They fade the move. They provide liquidity by taking the other side. But right now, they're covering. And when the smart money that usually profits from containment starts stepping aside, it's not because they've gone bullish. It's because they've done the math. They've looked at inventories. They've looked at redemption requests. They've looked at the cost of defending a short position in a market where physical delivery is becoming a real threat. And they've decided the risk-reward has shifted. This is critical to understand. The COMEX system works because most traders never stand for delivery. But if enough players decide they want metal, The exchange has to either deliver or allow price to rise until someone is willing to sell. There's no third option. And right now, the number of contracts that could theoretically demand delivery far exceeds the amount of registered silver available to fulfill them. It's not a conspiracy, it's just math. And the market is starting to price that math in. Let's add the macro layer. Silver isn't moving in isolation. It's moving inside a broader recalibration of hard assets relative to financial assets. Gold is near all-time highs. Copper is firm despite weak Chinese data. Platinum is waking up. These aren't coincidences. They're signals that capital is rotating into things that can't be printed, can't be diluted, and can't be restructured by a central bank. Whether that rotation is driven by inflation expectations, currency concerns, or geopolitical instability is almost irrelevant. The effect is the same. Real assets are being revalued. And silver sits at the intersection of two narratives. It's a monetary metal with a 5,000-year history as a store of value. And it's an industrial metal with growing demand from solar, electronics, and electrification. That dual identity makes it more volatile than gold, but also more explosive when both narratives align. Right now, they are aligning. Governments are running deficits that require either inflation or default. Industrial policy is accelerating the energy transition, which requires more silver per unit of output than the old grid ever did. And geopolitical fragmentation is pushing nations to stockpile strategic resources rather than rely on just-in-time supply chains. None of this guarantees that silver goes straight up from here. Markets don't move in straight lines. There will be pullbacks, there will be headlines that spook sentiment, there will be days when it feels like the move is over. But the underlying structure has changed. And that structure doesn't revert just because price corrects. The inventories don't magically refill, the accumulation doesn't reverse, the macro pressures don't disappear. What matters now is not the price. It's the behavior of the market at the price. Are shorts covering or doubling down? Are ETFs seeing inflows or outflows? Are premiums on physical silver widening or tightening? Are delivery notices rising or falling? These are the signals that tell you whether the move has legs or whether it's just noise. And right now, every one of those signals is pointing in the same direction. The other thing to watch is how the exchange responds. If COMEX raises margin requirements, that's a sign they're trying to cool speculative interest. If they widen the limit move bands, that's a sign they're trying to prevent another breach. If they start incentivizing deposits of physical silver back into registered inventory, that's a sign the float issue is real. These aren't conspiracy theories. They're standard risk management tools. But the fact that they might need to use them tells you everything about the state of the market. And here's the part most people overlook. This isn't just about silver. It's about what silver represents. It's a stress test for the entire commodities complex. If a relatively small market like silver can move this hard, this fast, with this much structural tension, what does that say about the stability of other markets where leverage is even higher and inventories are even tighter? It's a preview. Not a prediction, but a preview. There's also a timing element that deserves attention. We're entering a period where seasonal demand typically picks up. India's wedding season, Chinese New Year preparations, industrial restocking ahead of spring production cycles. These are predictable patterns. What's not predictable is how those patterns interact with a market that's already running tight on available inventory. In a normal year, seasonal demand gets absorbed without much price impact because there's enough buffer in the system. But when that buffer has already been drawn down, seasonal demand doesn't just lift price, it amplifies the existing supply tension. Consider what happened in the nickel market in 2022. A combination of war-driven supply concerns and a massive short squeeze pushed prices so high that the London Metal Exchange had to halt trading and cancel trades. That wasn't a failure of the market. That was the market revealing that the derivative structure had become disconnected from the physical reality. Silver isn't nickel. The markets are different. The players are different. But the lesson is the same. When paper claims exceed physical availability by a wide enough margin, price discovery breaks down. And when it breaks down, the reset is violent. Now, let's talk about what the data is actually showing beyond just the inventory drawdown. Lease rates for silver, the cost of borrowing physical metal, have been climbing. That tells you something important. It tells you that entities with metal are less willing to lend it out. Why? Because they either need it for their own purposes or because they're not confident they'll get it back in the same form and time frame. Rising lease rates are a signature of physical tightness. They don't show up when the market is comfortable. They show up when the market is scrambling. At the same time, the spread between spot silver and near-term futures contracts has been behaving unusually. Normally, futures trade at a slight premium to spot because of the cost of carry. Storage, insurance, financing. But lately, that spread has been compressing. In some sessions, it's even inverted briefly. That's called backwardation, and it's rare in silver. It signals that market participants value immediate access to metal more than they value a contract for future delivery. And that's not a speculative signal. That's a structural signal. There's another angle that doesn't get enough attention. Silver mining is not growing at the pace it needs to in order to meet demand. Yes, total mine supply has been relatively stable, but the marginal cost of production has been rising. Energy costs, labor costs, permitting delays, declining ore grades, all of these factors mean that bringing new supply online is more expensive and more time-consuming than it was a decade ago. And here's the kicker. Silver is mostly a byproduct. Roughly 70% of silver production comes from mines where silver is not the primary metal. It comes from lead-zinc mines, copper mines, gold mines. That means silver supply doesn't respond to silver price the way you'd expect. Even if silver doubles, a copper miner isn't going to ramp up production just for the silver byproduct. The economics are driven by the primary metal. So you have demand that's rising structurally from industrial use, from investment demand, from monetary concerns, and you have supply that's inelastic and slow to respond. That's not a short-term imbalance, that's a setup that can persist for years. And the longer it persists, the more stress it puts on the paper market, because the paper market ultimately has to reconcile with physical reality at some point. Let's bring this back to the 6650 level. Why that number specifically? Because it represents a point where the risk models that banks and exchanges use to manage exposure start flashing red. These models are built on historical volatility, correlation assumptions, and liquidity estimates. They assume that price will stay within a certain range over a certain period. When price breaks out of that range convincingly, the models have to be recalibrated. And recalibration means adjusting margin requirements, adjusting position limits, adjusting the bands for limit moves. All of that creates friction. And friction in a market that's already tight doesn't calm things down. It amplifies them. There's also a reflexive element here that's worth understanding. As silver rises, it attracts attention. That attention brings in new participants. Some of those participants are speculators looking for momentum. But some of them are late-stage accumulators who were waiting for confirmation that the move was real before committing capital. That incremental demand adds pressure. And as pressure builds, shorts who were comfortable at $60 start to get uncomfortable at $66. Some of them cover. That covering is buying. That buying lifts price, and the cycle continues until something breaks the feedback loop. What usually breaks it? Either a major macro shock that shifts capital away from commodities, or a supply response that floods the market. Neither of those is visible on the near-term horizon right now. Here's what institutions are quietly discussing, but not publicly broadcasting. They're running scenarios. What happens if silver goes to $75? What happens if it goes to $85? Not because they think it will, but because prudent risk management requires planning for outcomes outside the base case. And in those scenarios, the math gets uncomfortable fast. At $75, the number of underwater short positions grows significantly. At $85, you start to see funds and banks facing questions from regulators and counterparties about their exposure. At $100, the entire structure of the silver futures market comes under scrutiny. Again, these aren't predictions, these are risk scenarios. But the fact that they're being modeled tells you that the market is taking this move seriously. The retail investor, watching from the outside, sees a price chart and thinks in terms of profit and loss. The institutional player sees a map of exposures, counterparty risks, delivery obligations, and regulatory thresholds. They're playing a different game. And right now, that game is getting more complicated. Because the one thing institutions hate more than losing money is losing control. And when a market starts moving in ways that their models didn't anticipate, control becomes the primary concern. One more layer. Central banks have been net buyers of gold for years now. That's well documented. What's less discussed is that several central banks in emerging markets have also been accumulating silver, albeit in smaller amounts. Why? Because silver offers a similar monetary hedge at a fraction of the cost per ounce. For a central bank with limited reserves, diversifying into silver makes sense. It's liquid enough to be useful, tangible enough to be credible, and cheap enough to accumulate in size without moving the market, until everyone starts doing it at once. And there are signs that more central banks are at least exploring the option. This all ties back to a broader theme. We're in an era where trust in financial engineering is declining and trust in physical assets is rising. That's not a value judgment. It's an observation. Whether it's gold, silver, real estate, farmland, or energy infrastructure, the common thread is tangibility. People want to own things that exist independent of someone else's promise to pay. And silver, for all its volatility, fits that description. It's real, it's finite, and it can't be conjured into existence by a keystroke. The most important moves in this market are rarely the loud ones. They happen quietly, in the months before anyone notices, and the decisions made by players who don't announce their positioning. By the time it makes headlines, the smart money has already moved. And right now, the smart money isn't asking whether silver can go higher. They're asking whether the system can handle what happens if it does.